All right, so this month, 57% of global fund managers said that it was private equity and private credit. You see this bold line up there that was probably the most likely source of a systemic credit event. And, well, of course, the stock market's been worried about this all year long. You can look at a bunch of these stocks. I just put Apollo up there, but certainly Blue Owl would be even worse. These names in the PE industry, the stocks have been under a lot of pressure now. I can tell you, my next guest has been sounding the alarm for some time now. Let's bring in Verdad Advisers founder and managing partner Dan Rasmussen. And Dan, so you've talked about this. What is it that you saw, have been seeing, leading into now these major headlines?
Yeah, so private equity has been the darling of many elite investors for years, Charles. If you look at college endowments, they now have 40 to 50% of their endowments in private equity. Yale has been the leader of this. Pension funds now taking it up to 15 to 20%. And fundamentally, what are they investing in? They're investing in levered microcaps, tiny, tiny little companies with a huge amount of debt. And those companies account for about 5% of global market cap. So when you see companies take endowments, foundations, pension funds taking up to 15, 20, 40% allocation, what you've seen is a massive flow of money into a very illiquid niche, and that's a recipe for trouble, Charles.
So I read somewhere, though, like this whole thing, post-COVID, banks have been reluctant to invest. So private equity, I mean, they've stepped up, they're investing, they're buying everything, right? Everything in sight they buy, they jack it up, whether it's HVAC, whatever it is, and people complain about it. And I think one of the reasons, maybe if that's the case, then maybe they expect a bailout if something goes wrong.
I mean, it's getting so bad, Charles, right now. What you're seeing is these companies are not cash flow positive. They're cash flow negative, and they're not great businesses. There's not a lot of AI companies down in the HVAC space, right? And so what you're seeing is they're coming under pressure, they're having trouble paying interest, and their private equity owners are having trouble selling them.
We've gone from $460 billion to $3 trillion, and probably more. That was just at the end of last year. Is there a magic number? Is $3 trillion a number that we should start raising, sounding the alarm?
Charles, I like to say that lending is the second oldest profession, and rapid growth in lending never end well, because it's always a race to the bottom, right? The next person that offers a lower rate that takes more risk. And if you see the dates on here, 2013 to 2024, all of this growth has happened during a period where there's been no bankruptcy cycle. So these people do not have good risk management. They're people that started their firms, started this rapid growth after the last financial crisis.
Yeah, of course, we had someone, I think from KKR, saying, she was the one who said there's 19,000 PEs, private equity firms, and only like 14,000 McDonald's. You've got more private equity firms than Mickey D's out there. Another issue that some people have is that, hey, before, the exits route was like, PE would buy from PE, whatever. But now it feels like that's dwindled a lot, and they're spying 401ks in the retail market. There's some good stuff in there. How should our viewers be able to decipher what might be good and what's not?
Yeah, so you got to understand what's been happening is that traditional fundraising in private equity is down 3 years in a row. So the traditional buyers of private equity don't want it anymore. They're stuffed to the gills with it already. And if anything, they're getting out. They're selling their portfolios at secondaries. So what are the private equity firms trying to do? They're trying to raise money from retail. What you're going to see more of is these evergreen funds getting pushed into 401k plans. But the problem, Charles, these evergreen funds come with about 4% fee hurdles on average. So if you're thinking you're used to your typical 401k plan where you're paying 25 basis points, private equity funds stuffed in there, you're paying 4% on that. Great for Wall Street, bad for the average investor.
Wow, it's just absolutely amazing. Before you go, let's talk about some areas that you see an opportunity for investors to make money. Let's start with VTRS.
Great, Charles. So earlier we talked about value as being a big presence in the healthcare sector. Healthcare is cheap, and Viatris is a great example. Since 2020, it was spun out of Pfizer. Stock is way down. Now you're looking at a stock that's generating about $2 billion of free cash flow a year on about $11 billion of market cap. It's not necessarily growing, but this is like the legacy portfolio. All of the greatest hits drug-wise, the 2000s. You've got Xanax, Zoloft, Viagra.
Oh, really?
Viatris is the one that sells them.
Consensus.
Consensus Cloud, another healthcare name. This one is, look, Charles, I'm a bottom feeder. This does eFax. It's not a sexy business, not a growth business, but it spits off cash, huge dividend yields, and I think it's got a lot of potential here.
Rocky Brands. I feel like I know Rocky Brands.
You do know Rocky Brands. Yeah. I mean, you've got great shoes, Charles, but if you wanted to buy a pair of boots, you walked into an Academy or a Tractor Supply, you bought a pair of cowboy boots, it would be a Durango brand, that's a Rocky brand. You go buy a pair of work boots, Muck brands, also another Rocky brands. This company, like Viatris, trading at 10 times PE. Dirt cheap and growing 5% a year, and the stock's up 90% this year.
Wow, good stuff.
Thank you, Charles.
Really love that you walked us through that. Everyone's asking, what about private equity, private credit? Thanks a lot, Dan. Appreciate it.
Thank you.